Okay, here's a question for you. What if a business model was like super simple, incredibly durable, maybe generating predictable income for over 50 years, almost like a bond, right?
Right. Something really stable.
Exactly. But what if it also offered potential for real growth? And it was built on something totally fundamental, like the need for capital.
That's an interesting setup.
Well, welcome to our deep dive into Realty income. You probably know them as the monthly dividend company.
Oh, yeah.
That's the one. Our mission today is really to help you unpack this company. It seems straightforward. It's a REIT, a real estate investment trust, but we want to get underneath that.
Look at its actual business nature, yeah.
Yeah, what are its competitive advantages? What are the real risks, the opportunities, the stuff that defines its long-term potential? You've given us some amazing analysis to work with.
You've got a lot to cover.
We do. So we're going to pull out the most important bits, cut through the noise, and really get to the heart of what makes Realty income tick.
Okay, let's start at the foundation then. What is Realty income?
Well, fundamentally, it's a REIT, like you said. Owns and manages a huge number of properties.
How many are we talking?
Over 15,600. And these are freestanding, single-tenant commercial properties, mostly in the U.S., but also the U.K. and 6 other European countries now.
Wow, okay. Big footprint.
Huge. But the core, the real engine of the whole thing, is the triple net lease agreement, the NNN lease.
Okay, NNN or triple net. Break that down for us. Why is that so important for them?
Well, think of it like their secret weapon, almost. It means the tenant pays the monthly rent, sure, but also the 3 main property expenses.
Which are?
Property taxes, building insurance, and crucially, all the maintenance. All of it.
Ah, okay, so Realty income doesn't have to worry about the boiler breaking or the roof leaking.
Exactly. Or property taxes going up unexpectedly. It completely insulates them from those rising operating costs. It makes their income stream incredibly predictable, stable.
Like that bond you mentioned earlier. Very much like a long-term bond, yeah. And these leases, they're usually long. Think 10, 15 years, sometimes even longer.
Plus built-in rent increases.
Often, yeah. Contractual rent escalators just adds another layer of predictability. It's a model built for the long haul.
So simple, durable. Sounds like it's been their game plan for a while.
Since day one, pretty much. They started in 1969 with a really clear mission. Provide steady, increasing monthly income. That's it.
And you mentioned it taps into a fundamental need. Capital.
Absolutely. Businesses always need capital, right? For growth, for operations, whatever. And one key way Realty income gets properties is through sale leasebacks.
How does that work?
Okay. Imagine a company owns its building, maybe a big store or a distribution hub. They can sell that building to Realty income.
Get a chunk of cash.
Exactly. And then immediately lease it back. So they still get to use the property, but now they've unlocked all that capital tied up in the real estate.
Capital they can use for, well, whatever grows their actual business. R&D, expansion.
Precisely. It's basically a financing tool. A timeless need. Realty income is just sort of providing that financing solution using real estate.
And they're picky about who they lease to based on the analysis. It sounds like they aim for a defensive tenant base.
Very much so. They focus on tenants in specific kinds of industries. Service-oriented, non-discretionary things people need regardless of the economy. Or low-price point businesses.
Give us some examples.
Sure. Top categories are grocery stores, that's over 10% of their rent. Convenience stores, almost 10%. Dollar stores, over 6%. Drug stores, around 4.6%.
So businesses that tend to hold up well in downturns and aren't easily disrupted by, say, e-commerce.
That's the idea. They estimate something like 91% of their rent comes from these resilient sectors. It's about building a portfolio that can, ride out economic storms.
Okay, so this goes beyond just being a landlord collecting rent. The analysis really pushes this idea of a financing-like deal, even a capital partnership. What's the significance of that distinction?
It's actually pretty profound. When a tenant does a sale leaseback, they're essentially using Realty income like a bank, but for real estate capital. It's not just, I need space. It's, I need capital, and my building is the way to get it.
So it creates a different dynamic.
A much stickier dynamic.
Yeah.
Think about it. If you've sold your mission-critical store or factory to Realty income and are leasing it back, you can't just pack up and move down the street if rent goes up a bit.
Right. The switching costs are way higher than a standard lease.
Massively higher. It locks tenants in a way, enhances retention, makes that cash flow super durable. It's like an invisible chain almost.
Okay, so the model itself is strong. Simple, durable, sticky tenants. But what stops others from just copying it? What's their competitive advantage, their moat? The analysis calls it the fortress.
Right, and the moat isn't about running properties cheaper, because remember, the tenant pays most costs under the NNN lease.
What is it then?
It boils down to one crucial thing: their cost of capital. They can borrow money and raise equity cheaper than pretty much anyone else in their space.
And that comes from?
Two main pillars. First, sheer size, scale. Their enterprise value is around $80 billion. Over 15,600 properties. They are huge, like 4 times bigger than their closest competitor by market cap.
Okay, so size gives them clout in the financial markets.
Unparalleled access, yeah. They can do deals smaller players can't even consider. Second pillar, their balance sheet. It's rock solid.
Credit ratings.
A3 from Moody's, A from S&P. That's investment grade, very strong. It's like getting an A on your financial report card.
Which means banks and bond investors lend them money at lower rates.
Exactly. Because they see that long, stable history, that conservative financial management. It's a huge advantage.
So how does this lower cost of capital actually, make them money? Can we see it in action?
Oh, absolutely. Look at their big acquisitions. Take the Spirit Realty Capital deal earlier this year. $9.3 billion. All stock, so it didn't add debt directly.
And it helped their earnings.
Projected to boost their AFFO per share, that's adjusted funds from operations, a key REIT metric, by about 2.5% immediately.
No, just by buying Spirit.
Partly, but a key piece was refinancing Spirit's debt. Realty Income assumed about $4.1 billion of Spirit's debt, but because Realty Income has those great ratings, they could effectively lock it in at a weighted average rate of just 3.48%, much lower than Spirit could manage on its own.
Wow. So they buy a company, refinance its debt at their better rate, and instantly make the deal more profitable.
That's the power of the moat right there. Same thing with the VEREIT acquisition back in 2021. That was projected to be over 10% accretive to FO per share.
Mostly through refinancing again.
A huge chunk of it, yes. Refinancing VEREIT's higher cost debt at their own superior rates. It shows they can literally buy competitors and make money just by applying their better balance sheet. Smaller guys just can't do that. They're weaponizing their low cost of capital.
Okay, so the analysis argues this moat is stable, maybe even widening, but Morningstar rates them as no moat. What's their argument, and why does our analysis disagree?
Morningstar looks at the low internal growth, maybe 1% from rent bumps, and says Realty Income relies too much on buying new properties. And they argue the return on those acquisitions isn't high enough above the cost of capital to count as sustainable excess returns.
Basically, they're not making enough profit on each new deal to justify a moat rating.
Kind of. And while that might seem true if you look at just one deal in isolation, the analysis here argues that view misses the bigger picture. It misunderstands the compounding nature of this scale-based advantage.
Explain that, the flywheel idea.
Exactly. It's a virtuous cycle. Their huge scale and great track record get them that A rating.
Which gives them the lowest cost of capital.
Right. Which lets them outbid competitors for the best properties while still locking in a profitable spread between the rent yield and their borrowing cost.
And those profitable deals generate more cash flow.
Which increases their scale, improves their track record even more, strengthens the balance sheet.
Leading to an even better credit rating or maintaining the great one they have.
And an even lower cost of capital. The wheel just keeps turning, getting stronger. It self-reinforces.
And the proof against the no excess returns argument.
Look at the long-term results. A median AFFO per share growth of 5.5% per year since 1996. A total return of 13.6%. Compounded annually since 1994. That doesn't happen without generating real value above your cost of capital over time.
Plus, they're expanding into Europe, into new areas like gaming, buying casino properties like the Wynn Encore, and even data centers. That suggests the scale advantage is still working, finding new places to grow.
Precisely. We see the moat as widening, not shrinking.
Okay, let's shift to people and performance. How do tenants feel? Hard to measure love, but the portfolio stats seem telling. Occupancy, for instance.
It's pretty incredible. In their entire history as a public company, occupancy has never dipped below 96%. Never. As of Q1 2025, it was 98.5%.
That screams stability and tenant demand, right? Through thick and thin.
Absolutely. And look at lease renewals. In 2024, when leases expired and were renewed, they actually got 5.6% more rent on average. That's a rent recapture rate of 105.6%.
So tenants are willing to pay more to stay. Shows pricing power.
Definitely shows the locations are valuable. But there's always the big concern is the financial health of some key tenants, especially Walgreens.
They're a big chunk of rent, right? 3.2%.
Yep. And we saw a quote from a CEO of a rival REIT calling Walgreens bankruptcy highly probable. That's concerning.
Definitely a risk to watch. We'll come back to that. What about management? Sumit Roy, CEO since 2018. What's his approach?
He seems very focused on being the global consolidator, using that scale and cost of capital advantage to keep rolling up the fragmented net lease market.
Sticking to the core strategy.
Yes, and really doubling down on that defensive portfolio, the non-discretionary low price point tenants for resilience. But he's also innovating.
How so?
A big push has been diversifying their funding. They've set up a private capital platform. The idea is to tap into large pools of private equity money, which he called less volatile, far more voluminous than public markets sometimes. It strengthens their main advantage, access to capital.
Smart. And their overall capital allocation. Buying properties, M&A, dividends. How do they score?
Top marks, really. Acquisitions are disciplined, consistent. Around $4 billion a year recently, always focused on deals that boost AFFO per share.
The M&A, like Spirit and VEREIT.
Textbook examples of using their moat effectively. All stock deals, immediately accretive, logically sound consolidations.
Yeah.
Not just growth for growth's sake. It feels very shareholder focused.
And the dividend is obviously core to their identity.
Absolutely central. They're a dividend aristocrat, increased the dividend for 30 straight years, over 100 consecutive quarterly increases. They've paid out over $16 billion in dividends total.
Do they buy back shares?
Opportunistically. They authorized a $2 billion buyback program recently, but the dividend is clearly priority number one. All feels very rational, very owner-oriented.
And the financials overall. The analysis calls them an earnings machine.
It's hard to argue with the consistency. 14 straight years of AFFO per share growth. Positive operational return in 29 out of 29 years as a public company. Think about all the recessions and rate hikes in that period. It's impressive.
Key ratios look good.
Yeah, the AFFO payout ratio is conservative, around 75%. So they pay a nice dividend, but keep about a quarter of their cash flow to reinvest in growth.
Debt levels.
Very manageable. Net debt to EBITDA is around 5.4x. That's a comfortable level that keeps the rating agencies happy. And occupancy, as we said, is super high, around 98.5%.
And just to remind everyone, we focus on AFFO growth, not so much ROIC for REITs.
Right. Given how capital-intensive real estate is, AFFO per share growth is just a clearer measure of how much cash they're generating for each share outstanding. It cuts through some of the accounting noise.
Okay, let's talk valuation, the price to value question. For REITs, PE isn't the best metric. We use price to AFFO or PAFO. Where does Realty Income stand now?
Based on their 2025 guidance and a recent stock price around, say, $57, the PFO is roughly 13.3x to 13.5x.
How does that compare historically?
It's actually below its typical range. The 5-year median price to cash flow, which is similar, was over 16x. So 13.4x looks like a discount.
And the dividend yield?
Around 5.7% currently. That's quite high compared to its history, where it's often been closer to 4.5%.
So lower PFO multiple, higher dividend yield suggests the market isn't paying a premium right now.
Seems that way. Our analysis suggests it's looking like a fair, maybe even attractive entry point for someone with a long-term view. The market seems focused on risks, potentially offering quality at a discount.
What about the yield compared to treasuries?
The spread is a bit narrower than the long-term average, maybe 1.4% over the 10-year treasury right now, versus a historical average closer to 2%. That's mainly because interest rates are higher overall, but the absolute yield of 5.7% is still compelling for income investors.
Looking ahead, where does growth come from for such a large company?
Primarily, it's got to be more of that accretive consolidation, buying properties or portfolios where the cash yield beats their low cost of capital. That's the main engine.
But they're adding fuel to that engine.
Yeah, with those 3 initiatives we touched on. International expansion, especially in Europe, that's a huge market. New verticals like gaming and data centers offer scale. And that private capital platform could unlock a whole new level of funding for acquisitions.
Okay, but let's talk risks. Real risks. What could cause permanent damage here?
The biggest one has to be systemic tenant concentration risk. What if a whole industry they rely on goes into secular decline?
Like the Walgreens situation, but maybe broader.
Exactly. Walgreens is the poster child right now at 3.2% of rent. If they did go bankrupt, as that peer CEO speculated, well, the company says the current hit from all troubled tenants is maybe $0 on 2 cents of FFO. Small. But a systemic issue, like a fundamental shift away from drugstores or convenience stores, That would hurt much, much more.
What else? Could that cost of capital advantage disappear?
It's possible. That's a major risk. If interest rates stay super high for a very long time and competition for deals heats up intensely, or if they somehow lost their A credit rating, that spread between their borrowing cost and what they earn on properties could shrink or vanish.
And that chokes the growth engine.
Completely. The flywheel stops.
Yeah.
Then there's just the law of large numbers. Being so big makes it harder to grow per share. You need massive deals just to move the needle.
And the low internal growth from rent bumps, only 1%.
Yeah, that means they really depend on those external acquisitions. If capital markets seize up for some reason, their growth could stall pretty quickly.
Let's quickly check the health of their top tenants. 7-Eleven is number one.
Yep, 3.4% of rent. Their parent company, 7-I Holdings, has talked about a challenging consumer environment, some sales pressure. Still a massive global brand, though.
Dollar General, number two.
Looking strong, actually. Gaining share, good results, raised outlook, manageable debt. That's positive.
Then Walgreens, number three.
Clearly the weakest spot, as we discussed. Net losses recently, big turnaround plan, closing stores, high debt. That's the big one to watch.
And Dollar Tree, number four.
Seems to be improving. They're selling off the weaker Family Dollar part. The main Dollar Tree stores are doing okay. Debt is manageable, so kind of a mixed bag at the very top.
Okay, so let's synthesize this. There's the market view, and then our analysis offers a contrarian perspective. What's the general market consensus on realty income?
The market tends to see it as a bond proxy. Slow growth, high yield, moves mostly based on interest rates. There's a lot of focus on the risks in their retail portfolio, the Walgreens issue, and whether they're just too big to grow much anymore. The average analyst rating is basically hold.
But our analysis argues the market is missing something important.
We think so. The argument is the market's making a classic mistake, focusing too much on short-term cyclical things like interest rates and underestimating the long-term structural advantages.
Right, that cost of capital moat.
Exactly. The market might see a narrow profit spread on one deal and say no moat, but the analysis sees this self-reinforcing flywheel scale, rating, low cost, accretive deals, more scale as a powerful compounding growth machine. It's the difference between a snapshot and a motion picture.
And the market thinks growth is limited by size, but you see new avenues.
Right. These new S-curves, potentially.
Right.
That huge global net lease market, maybe $14 trillion with Europe barely tapped. The private capital platform opening up new funding. The market sees a giant hitting a ceiling. The analysis sees a giant stepping onto new, large playing fields.
Plus, the market worries about recessions.
While the analysis points to that incredible track record, 29 years of positive returns, occupancy never below 96%, suggesting it's built precisely to withstand storms, not just sail in calm seas. So if the market is pricing in fear, maybe there's an opportunity to buy quality at a discount.
Okay, powerful bull case. Strong counter arguments from the market. Let's really challenge this now. Red team time. What's the scenario where buying realty income today turns out to be a massive long-term mistake?
Okay, the nightmare scenario. It hinges on fundamentally misjudging how brittle that tenant base actually is, despite the essential label. Let's say Walgreens does go bankrupt. Not just struggles, but actually files.
The highly probable event happens.
Yes. It wouldn't just be the 3.2% rent loss, which is bad enough. It would be the signal it sends. It proves that even giant, supposedly essential tenants in this space aren't safe. Panic sets in.
How does that cascade?
Credit markets get spooked. Badly. They see the risk wasn't theoretical. Rating agencies react to maybe that A rating gets knocked down to BBB plus hold. Suddenly, poof.
The cost of capital advantage evaporates.
Overnight. The core of the moat is gone. Investment spreads collapse. The acquisition flywheel grinds to a halt. No more accretive growth engine.
And the stock market reaction?
The market reprices the risk of the entire portfolio. If Walgreens failed, who's next? Dollar General? 7-Eleven? That perceived safety vanishes. The PFO multiple doesn't just dip, it permanently contracts, maybe from 13x down to, say, 9x.
And the dividend, the monthly dividend company.
With the growth engine stalled and the balance sheet potentially under pressure, that cherished dividend eventually gets cut to preserve capital.
So the wonderful company turns out to be
a leveraged bet on retail models that were maybe more vulnerable than anyone realized. And the investor bought in just as the foundation cracked. Not just underperformance, but a permanent loss of capital. That's the red team view. It's plausible, even if not probable.
Okay. We've covered a lot. The incredible strength and consistency of Realty Income's model, that powerful scale-based moat, the solid financials, but also the very real tenant risks, the reliance on acquisitions, and that potent red team counter scenario. You, the listener, now have these critical pieces to weigh for yourself.
Yeah, a lot to think about.
So what does it all mean for you? Is Realty Income this timeless compounding machine that the market just doesn't appreciate right now, maybe offering a rare chance? Or is it more like a leveraged play on a retail world facing huge shifts, making it vulnerable to that kind of cascade failure we just talked about? How do you weigh decades of proven resilience against the possibility of a truly unforeseen systemic break? What really stands out to you from this deep dive?